You are listening to Digital Deal Hunter HQ, where the world's most elite digital assets are scouted, analyzed, and captured. We don't just look at websites. We hunt for cash flow empires, proprietary tech, and scalable ecosystems that others miss. From high-margin SaaS to global e-commerce powerhouses, we bring you the raw data behind the world's biggest listings on platforms like Flippa. Today, the stakes have never been higher. We are dissecting an $8.5 million global connected hardware ecosystem. This isn't just a business. It's a defensive fortress with over 185,000 subscribers and a verified 4-year track record of dominance. Is it a strategic masterpiece, or is there a hidden trap in the numbers? Stay tuned. Our panel of high-stakes acquisition experts is diving deep into the financials, the IP, and the red flags right now.
The business for sale marketplaces, scrolling past the endless sea of dropshipping sites, the affiliate blogs.
All those identical Amazon FBA clones.
Exactly, the clones.
Yeah.
You're about to just close the tab, and then a number jumps off the screen and grabs you by the collar. $8.5 million.
Yeah, that is a headline number that demands you stop scrolling. I mean, $8.5 million in trailing 12-month revenue, that's not a side hustle. That is a serious operation.
Serious is right. But it wasn't just the revenue that made me flag this for our deep dive today. We've got the broker listing and a ton of data here, and the title is Global Connected Hardware Ecosystem. So we aren't just talking about selling, generic widgets here.
Right, it's much bigger than that.
Yeah, we're talking about physical products, a mobile app with over 100,000 installs, and a subscriber base of 185,000 people. On paper, it looks like you'd be buying a miniature version of Fitbit or Ring.
It does, and that's the allure, right. But whenever I see the word hardware and the phrase $8.5 million in the same sentence, my brain immediately just splits into two camps.
The good and the bad.
Exactly. One camp is excited about the moat because it's really hard to build this. The other camp is absolutely terrified of the operations. Because hardware is messy, it's heavy, it breaks.
So the mission today is to figure out the truth. Is this listing a digital gold mine that's undervalued, or is it an operational anchor that's going to drown whoever buys it?
That's a billion-dollar question, or, well, the $8.5 million question.
Right. And I want to start with what the broker is very clearly positioning as the crown jewel of this whole thing, the audience data.
Which is the smart play.
Yeah.
Because in today's market, hardware without data is just a commodity.
If this were a company selling $8.5 million worth of, say, generic USB cables, the multiple would be rock bottom. But look at these stats. 185,000 subscribers, over 100,000 active app installs.
That's massive.
It is. That is a stadium, actually, that's 2 stadiums full of people who haven't just bought a product. They've intentionally installed code on their phones to keep using it.
And that distinction is vital for you to understand if you're looking at this space. It changes the valuation methodology entirely. In a typical e-commerce transaction, you're just valuing the profit. But here, you have to value the retention.
Because they're sticking around.
Right. When a customer installs an app, they are signaling that they want a relationship with the device. They aren't just using it once. They are engaging with it daily or weekly. And that opens the door for what every single investor wants.
Recurring revenue, the holy grail.
Precisely. Turning a one-time hardware sale into a monthly subscription. If you sell a standard toaster, you get paid once. If you sell a connected toaster with an app, you have a direct channel to upsell recipes, maintenance plans, newer models. You have retention equity.
They actually call it an ecosystem in the listing.
Yeah, and those 100,000 app installs are the proof of that ecosystem. That database is honestly likely worth more than the physical inventory sitting in the warehouse.
But let's play devil's advocate for a second. Having the potential for recurring revenue isn't exactly the same as having it on the books.
That's very true.
The listing highlights the user base, but it doesn't explicitly break out a massive SaaS revenue line. Software as a service, I mean. It feels more like they are selling the option to monetize these people rather than a proven recurring cash flow.
That's a really sharp observation. You see this a lot in Internet of Things listings. They have the users, but they just haven't fully cracked the monetization code yet. They're probably giving away the app functionality for free just to move the hardware.
Which changes the math.
Completely. So as a buyer, you have to ask yourself, is that list of 185,000 people an asset I can monetize, or is it a liability? Because supporting an app with 100,000 users costs money.
For costs, updates, bug fixes.
Exactly. If they aren't paying a monthly fee, they are technically a cost center.
That's the tension right there. But there is one number in this
Yeah.
data that suggests the brand loyalty is actually real, regardless of the subscription status. I'm looking at the channel split. 71% direct-to-consumer.
Now, that is the metric that impressed me the most out of everything here.
For context, when we usually analyze e-commerce listings in this $1 to $10 million range, they are almost exclusively Amazon FBA businesses. They live and die by the Amazon algorithm.
It's sharecropping. I mean, you work the land, but Jeff Bezos owns the farm. If you are 90% Amazon, you don't own your customers, you don't have their email addresses, you can't retarget them on Facebook easily, you are just renting traffic.
But 71% DTC means this company is driving its own traffic. They're acquiring customers through their own ads, their own SEO, their own reputation.
It implies they own the pixel, they own the data. If they launch version 2.0 next year, they can send one single email to those 185,000 people and generate $1 million in sales on day one.
Without paying a dime in ad spend to Zuckerberg.
Exactly. That is what we call owned media. A business with 71% DTC is significantly more defensible than an Amazon native brand. It justifies a higher multiple because it's just harder to kill.
Okay, so we have a defensible brand with a massive owned audience. This sounds fantastic. But we need to look at the engine room now. We need to talk about the money. Because when I saw the gross margin, I flinched.
32.7%?
Yeah, 32.7% gross margin. Now, if I'm a software investor, I'm vomiting looking at that. Software margins are 80, maybe 90%. Even in standard private label products, we usually look for 40 or 50% just to be safe. 32.7 feels really heavy.
It's extremely tight. Let's break down what that number actually represents in the real world. For every $100 this company brings in, $67.30 is gone immediately just to pay for the product and the landed costs.
Wow.
Yeah. You are left with $32.70 to run the entire company.
And that 32 bucks has to cover literally everything else. Marketing, payroll, R&D, and crucially for a hardware company, returns and defects.
And customer acquisition cost. The CAC, this is the killer. If they are 71% DTC, they are spending heavily on ads, Facebook, Instagram, Google. If their CAC is, say, 25% of the sale price, which is pretty common in competitive electronics,
Right.
then their contribution margin is only roughly 7%.
That leaves almost no room for error.
None.
It effectively makes it, say, a volume play. They have to move massive units to generate real cash. They aren't selling some luxury item with a 400% markup. They are grinding it out.
It suggests they are competing on price. And in hardware, that is a really dangerous game. If shipping container prices spike like we saw during the pandemic, or if the currency exchange rate shifts against you, that 32% margin can become 25% overnight.
Suddenly, you're losing money on every unit sold.
Exactly.
This actually brings up the concept of the cash trap. You see $8.5 million in revenue, and you think, wow, so much cash. But in a hardware business with these margins, describe the actual cash flow reality.
It's the cash conversion cycle. In software, you sell a subscription, the money hits your bank via Stripe, and you pay your server costs later. You have negative working capital. It's beautiful.
And in hardware.
In hardware, you pay the factory in Shenzhen a 30% deposit today. You pay the remaining 70% when it ships 2 months later. Then it sits on a boat for a month. Then it sits in a warehouse. You might not see the cash from the customer for 120 days after you spent the money.
So a massive chunk of that $8.5 million isn't sitting in a bank account. It's sitting in cardboard boxes.
It's floating on the ocean. The faster you grow, the more cash you suck out of the business just to buy inventory. A business growing this fast with 32% margins can actually go bankrupt while being profitable on paper.
Just because they run out of cash to buy the next batch of stock.
Precisely.
Which segues perfectly into the red flag section of our deep dive. The data specifically flagged logistics costs and inventory risks. The listing title says global. Now, usually global sounds impressive, right? Oh, we sell in 50 countries. But operationally,
Global is a nightmare multiplier. If you are selling connected hardware globally, you aren't just shipping boxes, you are dealing with compliance. You need FCC approval in the US, CE marking in Europe, maybe PSE in Japan.
the red tape is endless.
And you have to handle VAT filings in 20 different countries.
Not to mention data privacy. If you have an app with users in Europe, you have to be GDPR compliant. Users in California means CCPA compliance.
Exactly. The administrative overhead of maintaining a global connected ecosystem is massive. You likely need legal counsel in multiple jurisdictions. And let's not forget the physical logistics. If you have inventory in a warehouse in Germany, one in the US and one in the UK, you have 3 points of failure.
3 places where stock can go missing, get damaged, or just sit there collecting dust.
Right.
Let's talk about that dust factor, actually, inventory risk. In a dropshipping business, who cares? You don't own the stock. But here, you own the atoms.
And atoms rot. Not literally, but technologically. This is connected hardware. That means it has chips, Bluetooth versions, maybe a specific charging port. If Apple changes the standard next year or a competitor releases a device that is twice as fast for half the price, your inventory becomes completely obsolete.
It's not like selling cast iron skillets where the product is good for 50 years.
No. If you are sitting on $2 million worth of inventory and the market shifts, that inventory is worth zero. Actually, it's worth negative because you have to pay disposal fees.
No.
That is the risk premium you pay for being in the hardware game. You are constantly betting that your forecast is right. If you overorder, you die. If you underorder, you stock out and lose all your momentum. It is a high-wire act.
So we have a high-revenue, high-stress, low-margin business with a massive, incredibly valuable audience. This brings us to the final debate. Who is the buyer? Because the listing price for an $8.5 million revenue business is going to be in the millions. This isn't pocket change.
The buyer pool is very small, and I think we need to be very clear about who should absolutely not buy this.
Okay, let's role play. Buyer A, the passive income seeker. Maybe a wealthy individual, perhaps a retired doctor or someone who just had a liquidity event, looking for a place to park cash and get a nice 20% return. They see the revenue and think, I'll hire a GM and check in once a week.
That person will lose everything. Guaranteed.
Walk me through their day one.
Day one. A container gets stuck in customs in Rotterdam. The logistics provider raises their fees by 15%. A firmware update bricks 2,000 units, and the customer support inbox floods with 5,000 angry emails.
Sounds like a Tuesday in hardware.
Exactly. And the passive investor has no idea how to fix the firmware, no relationships with the factory to expedite a fix, and no team to handle the support volume. They are bleeding cash every single hour.
So that 32% margin gets completely eaten by crisis management.
And the stress. This is not mailbox money. Owning a global hardware supply chain is a 247 job. You are dealing with time zones in China, Europe, and the US. You don't sleep. Unless that individual has a full battle-hardened operations team ready to deploy, they are walking straight into a buzzsaw.
Okay, so we wave goodbye to the passive investor. Let's look at buyer B, the strategic buyer. A mid-sized tech company, or perhaps a private equity firm that specializes in consumer electronics.
This is the only logical home for this asset.
Why does the math work for them when it completely fails for the individual?
2 reasons: synergy and arbitrage. A strategic buyer likely already has a supply chain. They have warehouses. They have a massive volume deal with FedEx or DHL. They can plug this product into their existing infrastructure and instantly bump that gross margin from 32% to 40% just by economies of scale.
So they fix the efficiency problem right out of the gate.
Right. But the bigger play is the audience. Imagine you are a company that sells high-margin fitness subscriptions, but you struggle to get people to actually buy your hardware. You buy this company not for the profit, but for the 185,000 users. You acquire the customer base.
It's a tuck-in acquisition.
Exactly.
Wow.
You are buying the digital goldmine we talked about at the start. You cross-sell your other products to this list. You monetize the data. For a strategic buyer, the hardware is just a customer acquisition cost. They might even be willing to break even on the hardware just to own the network.
That's a fascinating distinction. The individual sees a business that needs to make a standalone profit. The strategic buyer sees an asset that feeds their larger machine.
And that's why the valuation can be so tricky here. A strategic buyer might pay a premium because they see value the individual just can't unlock. But for anyone else looking at that 32% margin and the inventory risk, you'd need a significant discount to make the risk worth it.
So let's wrap this up. We've looked at the stats. 8.5 million revenue, 71% DTC, tight margins, heavy operations. What is the final verdict on this global connected hardware ecosystem?
It is a reminder that in business, quality is subjective to the operator. To a novice, this business is a trap. It's shiny revenue wrapped in operational barbed wire. But to a pro, it's a platform. It's a hard to replicate asset because, as we've discussed, moving physical atoms is hard.
The fact that it's hard is the moat itself.
Yes, you can copy code in a weekend. You cannot copy a global supply chain and 100,000 active devices sitting in people's homes overnight. The friction is what gives it value.
That actually leads me to my final thought for you, the listener, to mull over. We spend so much time in these deep dives talking about SaaS, AI, and the cloud. The entire market seems totally obsessed with asset-light businesses. Everyone wants to scale infinitely with zero marginal cost.
It's definitely been the dominant narrative of the last decade.
But looking at this listing, I wonder if the pendulum is swinging back a bit. In a world of AI-generated content and endless digital noise, is there a hidden contrarian power in owning the physical touchpoint? When you have a tangible device in someone's kitchen or on their wrist, you have a loyalty anchor that a website can never replicate. Sure, the margins are lower and the logistics are a massive headache, but maybe, just maybe, the hassle of hardware is actually the price you pay for true customer ownership today.
Real businesses usually involve real work, and there is nothing more real than shipping a physical box.
That's something to think about before you bid on that next listing. Thanks for diving deep with us.
Catch you next time.
If you want to master the art of the deal, you can find the direct link to this Flippa listing in the description below. If you want to master the art of the deal and spot these gems before the market does, subscribe to Digital Deal Hunter HQ and turn on notifications. We find the deals, you make the moves. See you in the next hunt.